WBEN. To reach Esther now, call 803-0930, toll free at 1-800-616-9236, and cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulyas.
Hey everybody, this is the Tax Lady, and boy, we don't have too many days left till the end of this tax season. And so if you're one of those procrastinators, or even if you filed already and maybe you're waiting for your refund, there might be something you're going to learn today, because we always try to teach you something that'll help you on your tax journey, so to speak. And I have, of course, joined in studio with Christopher Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. Okay, so why should anybody even care that the deadline's coming?
Well, if they owe money, they got to pay it by April 15th.
No, but they want to file an extension.
Well, they still owe the money by
That's
April
right.
15th.
So when you file an automatic extension, it extends the time to electronically file that return till October the 15th. But you have to send money in with the extension, at least 90% of your liability, to make sure that it's covered, or else you're going to be penalized 5% per month until it gets to 25%. In 5 months, it's at 25%. Now think about that. If it was a $1,000 obligation, now you're up to like $1,250, and that'll just keep going and compounding. Plus, there's a 0.5% failure to pay penalty and interest on everything. So that's one of the reasons you want to file. I think the other thing is if you don't owe, if you get your refund. Right. I mean, with the price of money and the price of goods, don't you want your refund?
Oh, I know. Why are you waiting? Get it
Right.
done. Get your money. But I have 3 years.
Okay, and that's another thing. If you're somebody that's been waiting around because you do have 3 years, what happens at the end of 3 years?
You lose it.
You lose your refund.
Yep.
They keep your refund. So, and this year is going to close on May the 17th. That will be the 2020 tax return is going to close May the 17th, because remember back in 2020, that was all COVID, and they kept extending it. So the 3-year limit is up on May 17th, 2024, if you're looking at your 2020 tax return, which is really important, or you lose your money.
Right. But you don't lose your balance due.
No, you don't. If you owe them, you got to keep paying.
Right. So
that's a good point, Chris. Good point. The other reason why you'd want to file is to sit down and start planning for next year. If you find out you owe money, you want to change your W-4 at work right away. Or maybe you want to start taking 7 or 10% out of your Social Security, using that as a vehicle to get money in so you don't owe next year. Or maybe you have a kid that's going to turn 17 in 2024, and oh my gosh, the child tax credit evaporates, and all he's going to get next year to have this child in your home is $500 rather than $2,000. All those things are necessary when you're planning for next year.
Exactly.
Right?
Exactly.
I'm Esther Gulyas, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930, because we want to help, right?
For sure.
All right. Another thing I wanted to talk about, and so many people do not understand how their Social Security gets taxed, or if it's taxed. So is Social Security taxed, Chris?
Well, possibly. Very vague answer there. But it starts off tax-free, and then you have to look at all your income on your tax return, including tax-free interest.
Right.
And that will determine whether or not
So like Chris is saying, it's absolutely true. You start off with Social Security that may be tax-free. But when you add all of your income, including maybe municipal bond interest and other tax-free forms of interest, to your taxable money, and then half of your Social Security, you add that together like you're making a stew, and you come up with an answer. If you are a married couple and that answer is under $32,000, then it's true. Your Social Security is tax-free. If you're single and that answer is under 25,000, then you're right. That Social Security is tax free. However, if when you add all those things together, including half your Social Security, the answer exceeds 32,000, then what happens?
Then it starts to become taxable. You take the amount, so say you're at 34,000, 34 less the 32,000 exemption, basically, is $2,000. Divide that by 2, and you have $1,000 taxable Social Security.
Right. But here's what's interesting. So let's say that you had tax-free interest of $5,000 along with some pensions, and you get past that $32,000 threshold, and you have $1,000 that's taxable. That's applied against your standard deduction, right?
Right.
So even though you might have some taxable, you might not pay taxes on it.
Exactly.
It's like saying, is this deductible? Yeah, it's deductible. Will you get any benefit for it? Maybe not. Just because it's taxable or just because it's deductible doesn't mean it actually gets taxed or
Correct.
deducted.
Correct.
Right?
Yes.
I'm Esther Gilius from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we're going to go to a phone call, and we're going to talk to Tom. Hi, Tom.
Hi, yeah, I'm renting out part of my home. It's split. I have a 1-bedroom and a 3-bedroom. I'm renting out the 3-bedroom side, but all the utilities are included in the rent. Do I get to claim any of the utilities or any of my taxes?
Of course you do. So what you're going to do is an allocation. So if the house has 4 bedrooms and you're living in 1 bedroom and the rest of the house has 3 bedrooms, it appears that 75% or thereabouts, or actually to do it correctly, you would do square footage.
Okay.
That would mean that about 75% is going to be business. Now, are you renting it to a relative or are you renting it to a stranger?
It's a friend of a relative.
Okay, so are you renting it at fair rental value?
No, I'm getting rent from social services from her, and every time I try to raise it, I can't. I'm only getting $350.
Why can't you?
Well, because that's all they will pay. I'm only getting $350
but here's the thing,
a
Tom.
month.
In order for you to take any of those expenses, you have to have a profit motive. And so if you're renting it below fair market value, all you're allowed to take is the expenses up to the rent you're receiving.
And
Okay.
can your tenant not pay you any money on top of what you're getting from social services?
No, not at all.
You mean because they don't have the money?
Right.
Not because the social services is saying they can't, but it's just they don't have the money, right?
Yeah, they don't get any money because they're not working, and they
Why
don't
don't
get any
they
money.
work?
They're just kind of a disability. She applied for disability.
I see.
And
I see.
it's right now she's just social services never let me raise the rent for some reason.
Okay, so let's back it up. So if 75% of the house is used, and if it is rented at fair rental value, then you get to take 75% of your expenses that are allocated to that side of the house to reduce the income you received. If you are not renting it to a relative, but you're kind of going easy on the rent, then all you can do is take your expenses up to your rent so that you don't have to pay any taxes on it.
Okay, and what form would I use for that?
Schedule E.
Form, it's Schedule E?
Yes.
Okay. And what about the taxes on the home? You can't take any of that?
Well, everything, again, as long as it's used to offset the income you received, you're going to have to allocate all of your expenses, your property taxes, mortgage interest, insurance, utilities, etc. But you can't, because you're renting it below fair market value, you can't take a loss.
Okay, yeah, I didn't want to take a loss. I was just trying to make up for take off the amount of rent that I could. My parents used to rent it out. They owned the house before, and they used to get $125 a month. and
Oh,
they
my
never had
Long
to
time ago.
claim it because they always said it was like a loss, so they just never
Yeah, well,
bothered.
you're not allowed to take a loss when you're renting it below fair market value.
And this is
Okay,
you
but-
have a 2-family home,
Yes,
right? Yeah.
Yeah.
yes.
Yeah.
Schedule
Okay,
E,
Tom?
right?
Yep. Schedule
Okay,
E.
thank you. I appreciate
All
it.
right, thank you, Tom. Thanks for calling. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to take a short break. We'll be back on the other side with your calls. Hey, family, this is Esther Gilius, the tax lady, trying to help you get everything squared away here before the 15th of April. And I'm joined in studio with Chris Fabian, and we'd love to hear what you have to say. 8030930, 8030930, star 930 on a cell phone. And you can text us at 716-8030930. And we got a couple texts, right, Chris?
We do. First one says, "Hi, I have a new small LLC sole proprietor business, maybe $20K a year. I also have a W-2 main job. Do I have to file business income tax quarterly? How does that work? New to this."
Okay, so here's the thing. If when you file your return, you find out that perhaps you didn't make much money and you're going to get a refund when you add that all towards your other income and your W-2, well, you don't owe the IRS any money. You don't have to worry about paying estimates. You pay estimates if after you have your other forms of withholding, if it doesn't cover your tax liability plus $1,000, then you really need to make estimated payments and prepay that projected liability. But many people, especially I can think of husbands and wives where the husband might have a lot of withholding, the wife has a marginal business, and they still get a refund, so they never pay estimates. But if you're somebody that as your business grows, you start finding out that you're having a balance due, then you have to do estimates.
Right. And is the $20K your gross or your net? Because just because you made $20,000 in gross, like Esther said earlier, you get to back away your expenses. So you may only net $2,000.
Right.
So your withholding from your main job may not have any impact on it. But when did you create your LLC?
Oh yeah, here's some bad news we want to tell you. Tell them about the BOI FENCEN.
Yep. If you created that if you created the LLC last year in 2023, then you have to the end of the year to do your BOI reporting with the federal government. If you created it this year, you only have 90 days from the creation to get that done
Get
with the
yourself
federal
registered.
government.
And here's the thing. Failure to comply is a $500 per day penalty until it gets to $10,000. So it's very, you want to make sure that you find out about it. So
Yes.
thanks for the text, but make sure that you look into, you can Google BOI FENC. Is it FINCEN?
FINCEN.
And you're going to find out that it says it's the Department of Treasury Fraud Identification Bureau, and so they want you to register. Failure to do so could cost you $10,000.
Yeah.
Okay, let's go to Ed. Hey, Ed, how can we help you?
Yeah, I got a question in regards to a late rollover. I did a CD rollover from one large bank to another large bank in January 12th of this year. And now I found out in the last few days here that where I transferred that money to was actually not an IRA rollover. It was to a savings account. So now I am past the 60-day rollover, I guess, mandate. And now I'm like 84 days into that rollover now I'm going to have to transfer it. But that was in a CD also. So I transferred it into a CD, and I had to close that savings account out because I have to get that back into my IRA rollover. And I also took a hit on that CD, and it makes that account actually worth less money than when I originally rolled it over. So it's worth a little bit less money.
Let's back up, Ed. You
Okay.
had an IRA, correct?
Yes.
And it was a CD IRA, right?
Well, I had an IRA at Bank A in a CD that matured. When that matured,
Okay, was it a CD IRA?
Yes.
Was it an IRA in a CD?
Yes.
Okay. So then you went to Bank B and you gave them this money and they opened up a CD but not an IRA, correct?
Exactly, a savings account, which
All right.
I didn't realize.
Well, unfortunately, you're going to end up having to pay taxes on it.
But isn't there some type of certification for a late rollover?
You didn't do a rollover. All you did was take the money out of an IRA and you deposited it into Bank B. You didn't do a rollover. A rollover would have been from Bank A to Bank B, IRA to IRA, and they transfer it electronically, and you don't touch the money. When you went to the bank with the check and you didn't open up a CD IRA, then it makes it taxable.
Well, it was an electronic rollover, just to let you know, from Bank A to Bank B. And the other thing is
It was a trustee to trustee transfer?
Yes.
Well, then why didn't you get the bank to pay the penalty? Because the bank screwed up.
Well, that's the whole
I
thing.
mean, the bank, if it was a trustee to trustee transfer, you didn't touch the money.
No.
No. And they knew it was an IRA at Bank A, and Bank B didn't think that it was going to be an IRA?
Yes.
I mean, did you tell them this is an IRA?
Well,
did you
that's what
sign
I told them I wanted to do. I wanted to take it from an IRA, from Bank A IRA, and put it into an IRA rollover CD.
Well,
and
I
then
would
they
talk
put
to
it-
my attorney about it, but I'll tell you, you're gonna pay taxes on it.
Well, the Bank A just sent me out a certification
A
for late
1099-R.
rollover. Yeah, and it says on there that there's reasons for a late contribution. One of the reasons is the distribution was deposited into and remained in an account that I mistakenly thought was a retirement plan or IRA. And
Right. Well, that's why you would have to go back to the bank and see what paperwork you signed. Because if they screwed up, yes, that would be an exception. But if you didn't sign paperwork saying for an IRA, that would be not good.
No, I get it, but then I'm reading on the IRA or Internal Revenue site that there is even a self-certification if something like this happens.
It's all going to go down to interpretation by the IRS
Right.
representative that handles the case. So if you have it where the bank screwed up, you would have a better chance than you just saying you screwed up.
Okay.
Did they send you a 1099-R, Ed?
No, this has just happened. This is January 12th of this year when I did that. So at this point, they haven't sent me nothing because it's
Well,
not
boy,
the end of the year.
I'd go make some waves.
Okay, because it's a pretty big bank. They're both big banks.
Well, I'd go make some waves if they were ordered to do an IRA and they didn't. Yeah, I think it falls on them.
But what if I don't
I mean,
have
you
proof
have
of
to
that?
have the proof that this all is true. So I would go make some waves and see what they do.
Okay. All right, because I also because I had to withdraw that money out on that CD, I took a substantial hit for early.
Well, that's
early
something, like
withdrawal.
Esther said, you probably could go back to the bank and
Right.
have them.
Because the only thing that's taxable then would be the net amount that you withdrew from that IRA. But you gotta go back to the bank and make some waves. Say what you guys are gonna
I will.
cost me tax
I will,
dollars.
But have you? But let me ask you. I will do that. But have you ever heard of a waiver? Internal from what it says on the IRS site, there's a possibility of a waiver for the Internal Revenue.
Right, that's what I said.
That's when you fill out the form and you ask them to have mercy on you, okay? But that would be completely up to the IRS then.
Okay.
I mean, if you could get it straightened out on this end, believe me, you will be happier.
Well, I already closed the account out. That's the other part of the story.
Well,
I
I would
closed
go
that.
on Monday, talk to the manager, and don't leave till you get it all resolved. Get the proof that it was their mistake, especially if it was a trustee to trustee transfer. They
Right.
knew it should have been
Right.
in an IRA. So
Okay, look, it's a big online bank. I don't actually have anybody to deal with, but I can call them and ask them. Would I see that in my paperwork that it was a trustee to trustee transfer?
Well, it meant that you didn't get the money. The money went from Bank A to Bank B.
who filled out the paperwork?
I did it online.
Well, then get a copy of that paperwork, and it should say trustee to trustee transfer.
Okay. All right, very good. That's what I'll do.
I mean, I feel really bad for you because you don't want to have to swim upstream, you know. So I
No.
would really go over there and I'd talk to them, make some noise.
Yeah. Okay, I'll call them and I'll try to find out if I can find that our original paperwork from the trustee to trustee transfer.
There you go. There you go.
Okay. Very good.
Okay.
All right, thanks. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone.
We'll do another text.
Yeah, we'll do a text.
Before the news. If children inherit funds, both IRAs as well as non-IRA funds, including stock accounts and bank accounts, plus a house from a deceased parent, do the children have to pay inheritance tax and or estate taxes on all those funds, or just the IRA withdrawals? And is that a New York State only, or the other states like Texas or Illinois too? So, well, believe it or not, the IRAs, depending on it all depends on their age. Because if they are minors, they do have to their 21 before they have to start taking out of an inherited IRA. So if they dip into it, whether they're minors or now, yes, that would be income from the IRAs. The stock accounts would be if they sell the stocks, then it would be taxable. The gain would be taxable from the date of death to they sold it if there's a gain. The dividends would be taxable. The house, if it's the house they're living in, that's tax-free. There's nothing you have to worry about.
All right, and that's true. Now I was looking here at the regs about our caller Mike from Town of Wanda. The IRS will consider all relevant facts and circumstances under Revenue Procedure 2003-16 for situations where taxpayers receive automatic approval of waivers due to the financial institution's error. So that you have to be able to prove that they made the error, and that's the important part, right?
Right.
Okay. And actually, we're going to take a short break for the news. We're going to be back with Kathy and Mike and your texts and calls on the other side. Thanks for listening. Hey, family, this is Esther Gullius, the tax lady who has not too many days left in her busy schedule till the end of tax season. And we're just trying to help you through the mess here. If you're sitting around and you haven't started your stuff for this 2023 tax return, now's the time to get going because time is a wasting, and we want to make sure we can help you. Our phone number here in studio is 803-0930, 803-0930, star 930 in a cell phone. You can text us 716-803-0930. We'll go to Mark. Hey, Mark, how can we help you? Thanks for waiting.
Hi, good afternoon and belated Happy Easter.
Yeah,
The reason
thank
I'm
you. You
calling, yeah, thank you. The reason I'm calling is I'm calling about the property real estate tax in New York, and to get that benefit, you have to file a certain form. Is that correct?
The New York 229.
Right. Do you have to file the IT 214 also?
No, that's the old form.
Because I did file it, and the New York State sent me a letter, and they said I had to file the IT 214.
Well,
Unless you put it on the wrong line on the tax return.
You might have made a mistake, and they're ignoring it. So the IT 214 is the is the property tax rebate, and that's the one that's
Right.
very small. But the IT 229 is the one that's based upon if your property taxes exceed 6% of your adjusted gross income. So
Right.
we haven't the IT 214 is one thing, but the IT 229 is another.
Hey,
Yeah,
there's-
so you-
I mean, I filed the other one first, and 2 weeks went by, and I just got this one, a letter in the mail from the
Did-
New York State. They said you've got to file the 214 also
Did you do it by paper or electronically?
by paper.
I bet you made a mistake on what line you put it on the tax return. I would say bring it to one of our offices
And we'll look
with
at
a
it.
copy of your return, and we can take a look at it.
Okay, yeah, because I looked it over several times. There was no mistake. I don't think I followed all the lines, the numbers. and
Well,
everything.
one thing with it being paper, the person who inputted in the computer on New York's end may have made a
That's
mistake
true,
too.
Yeah, that's possible. All right, well, that threw me off, and I couldn't wait for Saturday to come around. I had to ask you what's going on, but I might bring it
Well,
in. and
that's
have you-
great. We love helping you.
Thank you very much.
All right, thank you. Thanks for your call. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. What else we got here?
It says, is the last day to submit your state and federal 2020 taxes April 15th or May 17th?
May 17th.
Yep.
Because the tax season ended that year in 2021 on May 17th. And the statute of limitations is up on May 17th. But don't wait till the last minute. You know,
Right.
I mean, don't sit around and say, I think I'll do this on the 16th. It's just not a good practice. And on top of everything else, if you're doing it, you got to do a paper return because you're now late. You know, you want to make sure that they're going to get it postmarked and received by that 17th date.
Correct.
Okay?
Yes.
Okay, let's go to Mike in Tonawanda. Hi, Mike. Hello, Mike. No. All right. We'll try to get Mike back. 8030930, 8030930, star 930 on his cell phone.
And we got another text.
We do. Okay,
Yep,
what do we got?
It says, if a married couple files a joint return and only one of them is employed, are both able to make an annual contribution to an IRA?
Maybe. And really it has to do with, does the other spouse have a qualified pension plan, and what is your income? Because if your income is very high, then even though your spouse has the only pension plan, they may preclude you from doing it. But if, let's say, your income is around 90 or 100,000, and he's got he's got a pension plan at work, you would be able to get a spousal IRA. Okay, depending upon what your age, and that would be the determining factor as to how much you could put in. But if he doesn't have a pension plan, you don't have a pension plan, you guys can both put money into an IRA, traditional or Roth.
Correct. Yes.
Okay.
Yep.
Okay. Yeah, I wanted to talk about the great ripoff of gambling on your tax return. Because people know that when they come in, or that when they go gambling, they get all those little yellow slips, and they can take their losses. So they get the win-loss sheet, right? So let's say somebody wins $10,000 at the casino, and the win-loss sheet says they lost $15,000. So the most taxpayers think you put the 10 in, and you deduct 10 up to losses up to winnings, and so it wipes it out. Is that true, Chris?
Well, do they own a home? Do they have large medical bills? What is their charity?
Well, even if they owned a home, let's say that they had no medical, because that's 7.5%. Let's say that they had $10,000 in taxes and no mortgage, and maybe $1,000 in charity. So
Right,
they'd
so
only
they-
have
well,
11, and then with the 10,
That's 21,000. So
Right.
they're not getting the full benefit, but it will help them.
Well, no, because if they're
if they're married,
couple,
I thought
right.
I'm thinking single
Yeah.
person.
If it's a married couple, they get no benefit at all,
Correct.
and they pay taxes on the gambling winnings, even though they had losses.
Correct.
And that's what happens so many times.
Yep.
Is that people will say, "Are gambling losses deductible?" Yes, they're deductible, up to the gambling winnings, but because of the high standard deduction, you may get no benefit at all when you list those gambling expenses.
Yep.
But maybe on the state,
Yeah.
right?
Yeah.
Because the state standard deduction is lower than the federal. So maybe on the state. But I thought it was important to analyze that because people go to the casino not realizing about their gambling losses are really not going to be written off on their tax return.
Well, how about another myth with gambling? People who do get to itemize it, that say somebody wins $500,000 at the casino, and they lost it all. What does New York do to them?
Oh, well, New York is going to limit what they can take, right?
Right? They're not going to be able to itemize, so
Right.
they're going to have to pay tax
Right.
on all that $500,000. So it's, and then, I know if Tiffany was here, she would be going, "Don't forget about Irma."
And that's the other thing. Some of these win, you got to understand the whole picture. If you have this windfall from gambling, for instance, number one, you might not be able to take the losses. Number two, it's going to boost your adjusted gross income, which will put a crimp on your Medicare contribution.
Yep. Oh,
So,
yes.
Again. All right, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Okay, another thing I wanted to talk to people about is when to collect Social Security. Right? Because many people think that, they kind of get mixed up about how much you can earn and still collect Social Security. When is that only relevant, Chris?
When you're up to the required
normal
retirement age,
right.
which is like 66.678.
Yeah, and it's almost 67 right now.
Yeah.
So from the time at 62 when you are eligible to collect till you're at full retirement age, FRA, then you're limited to the amount of money you can make. And this year it's $22,320 before you would have to pay back some of the Social Security that you're collecting if you chose that option.
Right.
Right? So then once you reach full retirement age, how much can you earn, Chris?
As much as you can.
That's right. Whatever you want. So there's
Yep.
no limit. So prior to full retirement age, if you're taking the early benefit for Social Security, you're working, then you can make $22,320 before you'd have to pay back $1 for every $2 you go over that threshold. Now, let's say that somebody is 63 and they're collecting Social Security and they have a $40,000 pension. Does that mess up their
No.
collecting? Right. Correct.
Because that's not earned income. Pension is not earned income.
Right. So it's earned income, self-employment income. That's what all filters into that, whether or not you'd be penalized if you made over the $22,320. So, but the thing is, when you collect between 62 and 67, if you can live within that income restriction for wages, then you are going to take a 70% hit on your Social Security benefits, okay? And so a lot of people think, oh, well, that doesn't sound like a good thing. But here's the how it all breaks out. Let's say that you're, I got it all written down here. Where is it? Well, can't find it. What? Anyway, you take a hit, but the thing is, you leave on the table like $110,000 if you don't take it at 62. If you wait till 67, and it takes like 12 years to break even.
Yep.
So many of these decisions that people have to make is, do you you have to understand your longevity. If you wait till 70 to collect, it takes like 13 and a half years to break even. So you'd be 83 before you break even. So you have to think about that as a financial decision.
Right. And also, it's Social Security, as I tell people, it's imaginary money until you start receiving it. It's like monopoly money. So you're going to get an 8% growth every year, right? But say you pass away at 65 and you could have collected at 62.
Right.
Where's that money?
It stays with the Social Security system.
Right. The government won.
Well, I found my example here. So if you start collecting at 62, you could collect at 62, and you're going to wait till 67 for whatever reason, you leave on the table $117,600. And so it's true that you'll get a benefit of an additional $1,960 per month if you wait, but it's going to take years. Let's see. I think, yeah. You wouldn't break even until you're 74. So if you are thinking about waiting, you really have to put a pencil to it. And like Chris is saying, unfortunately, the Grim Reaper's at the door. We don't get out of this world any other way but to pass away. And so the reality is, maybe you want to wait till you're 70, and it's true you're going to get a great big benefit. But what if your longevity is only till 72, and you won't break out even until you're 83? So that's something to think about.
Right.
What do we got here?
Why don't we take a fast break?
Yeah, we'll take a quick break. Give us a call, 8030930, 8030930, star 930 on a cell phone. Don't forget, all of our offices are open 9 to 9, Monday through Friday, 9 to 5 on Saturday. We'll get you done. Hey, this is Esther Gilius, the tax lady from EG Tax. We got not a lot of time before April the 15th, and it does close April the 15th. It's a week from Monday, so if you need to get your stuff done, EG Tax will help. We have 31 area offices to serve you. You can go to our website at egtax.com. All right, we have a big text.
We got a big text, another novel. It's going back to inheriting, We're going to suggest either calling the radio show.
Or you can call the radio show. We'll talk.
Yep, call the radio show. We'll talk live, or call one of our offices, and we'll be able to assist you that way, too.
Because this is a big one, and, and there's no details. So, okay. All right, let's go to Mike. Hi, Mike. Hello, Mike.
Hello, are you hearing me?
I'm hearing you.
Okay, so I was the executor of the estate for my parents who deceased, and I did not take the executor fee. Instead, it was just divided between the three siblings. And as far as New York State and tax, and do I have to file anything special, considering that the house was below $200,000?
Sorry.
No, go ahead, Chris.
You mean filing for the estate?
Yeah, I mean, overall, once the money was divided between the three children, is there anything that I have to file for New York State or federal regarding that?
Did you talk to an attorney, Mike?
I did.
All right. Did the attorney say that? Well, they didn't have an estate over $11 million, did they?
Absolutely not. No.
All right, and everything was distributed with the house. That's all the only assets.
Yes, ma'am.
And they had a will.
Yes, ma'am.
So if the attorney thought you're good, close it up.
But was the estate, who sold the house? The estate or you and your siblings?
Me and the siblings.
So you guys were listed on the closing paperwork as a seller.
Yes. Yeah.
Okay. Then, nothing for the estate.
Right. And then, you would do a 1041, a fiduciary return, if there was money that their assets made after their death. But if there was no
No.
money that was made, then you wouldn't do a
No.
1041. You might want to do a final return if they had a refund coming, or they had a tax liability if there was money that was made prior to their death. But if the attorney agrees and there's no other assets, that would be great. Everybody splits it up.
Okay, I appreciate it. I just wanted reinforcement on that, so I do appreciate that. Thank you.
All right, thanks, Mike. And then let's go to Lori in North Tonawanda. Hi, Lori.
Hi, Esther. How are you?
I'm great.
Good. I have a Social Security related question. If I'm going to be 66 years and 8 months at my full retirement age in July of next year, what I was told by a Social Security representative was I can draw in January of next year, but my income's limited to 56,000. Does that sound right?
That does, because the year that you're collecting, they kind of give you a break, understanding that if you were still under the age of normal retirement age, that you'd be limited to the 22,000. In that year that you're collecting, that you turn full retirement age, they kind of have this little allowance that gives you more money that you can make and still collect.
Oh, so if I waited 6 more months, I would have unlimited earning ability then.
Right.
Because it's
right. But I
right?
mean, the 6 months. I mean, going forward, there you'll be good to go anyway.
Yeah, if you're still working.
Right. You'll be good to go anyway.
What do you mean by good to
In
go?
other words, once you're full retirement age in 6 months, you can earn $1 million. It doesn't make any difference.
Right. But if I take it 6 months in the year I turn, which would be 6 months early than my full, I'd be limited. Would that be a stupid
You'd be
decision?
limited to that $56,000 figure. Do you make a lot of money, Lori?
No, I make about that.
Okay, well, you want to make sure you check with the Social Security Administrator and find out if you would be penalized because because you have to comply with that threshold.
Okay. Otherwise, they deduct? Is that what it is?
Otherwise, they deduct.
Yeah, you would either have to
Right.
pay them back,
Okay. All right. I was a little confused on that.
Yeah, so basically, though, they're like doubling the amount of money that you can earn and still collect, if you want to collect early. But I would look specifically at your situation with somebody at Social Security and see if it's going to put you in a payback situation.
Okay.
Okay?
All right. Well, that
Thanks,
helps a
Lori.
lot.
All right,
Thank you.
Thank you very much. I'm Esther Golias, the tax lady from EG Tax. You can go to our website at egtax.com, which will give you all of our locations for all of our offices. And if you're somebody that needs an extension, we're going to be doing extensions by the yard, aren't we, Chris?
Oh,
pretty
God,
soon?
yes.
Okay, what else we got here?
I turned 63 in May. Could I be leaving money on the table by not filing for Social Security when I do not need the income now? And are you able to explain why, if adding the last year's Roth IRA is more beneficial than adding it to this year's before the tax due date?
I don't know why it'd be more
A
beneficial.
Roth doesn't, besides the retirement savings credit.
The Roth IRA is not deductible. There is a retirement savers contribution credit that they give you for funding a pension plan, either a traditional or a Roth or a 401k, but it isn't any better this year than last year.
Right.
So you have to understand, when you are collecting Social Security, you're leaving, and you choose not to collect, you are leaving a lot of money that hasn't been that they get to keep because you want the higher figure. That may be what you want to do, but there are people that have the ability, that need the money, that are saying that they should wait, and they're taking money out of taxable sources. You really have to put a pencil to it with your situation. Your health is another factor you have to look at, because remember, in the event that longevity is not on your side, you may never ever be able to recoup what you leave at Social Security.
And then also what I tell some of my clients is at age 82, normally the catch.
Woohoo!
What do people normally think of? Not a trip to Aruba.
A trip to the nursing home.
It's a trip to the nursing home. How to protect my money. So who actually wins?
Social Security.
Yeah, the nursing home.
Yeah, right, absolutely.
Yeah.
I mean, I had a client the other day paid $170,000 at a nursing home.
Yeah.
Right? And so those are all things that, remember, it's not just the taxes you pay, it's your overall financial benefit. Like, for instance, I had a client that just got a $40,000 Teamster settlement, and he was complaining about his tax situation. And I said to him, let me put it to you in a way that you'll understand. It's good that you got the money, and nobody likes paying taxes, but if you give me the money that you got, the $40,000, I'll pay the taxes for you. And he said, well, no. And I said, but that's really how you have to look at taxes.
Yeah.
Nobody likes paying them, but it's a lot better to have money than not have money.
Yep.
Right?
Yes.
Okay, if you guys have any questions, I wanted to do something that we haven't done for a while. You can get, a lot of people are wondering where they can get some high yield CDs. You can go to CNET Money, and it'll give you a list. Like BMO Bank is paying 5%, and let's see. Barclays Bank is paying 5.15. And so there's a lot of banks that are paying a lot. Make sure that when somebody's is quoting you the amount that they're giving you, 5% would be 5.0. 0.50 does not mean the same as 5.0, does it, Chris? Because 0.50 means 0.5%.
Right.
And I just had a client today that thought they were getting 2%. They were actually getting 0.2, which is 0.2%.
And sometimes you have to ask the bank, don't you have anything better for me than what I'm getting right now?
That's true. If you talk to your banker, you may find out that they may not be advertising a 5% rate, but they'll give you a 5% rate if you ask for it.
Yep.
And the other thing is money markets are also paying 5%. So if you're somebody that's been saying, I don't know if I want to do this, it's money that you're leaving on the table. So, but if you need the best tax help for the least amount of fees, give EG Tax a call at our corporate headquarters, 632-7886. Go to our website at egtax.com. And I know that the eclipse is happening tomorrow. Wear the glasses, or just think about all those eye doctors.
Medical bills.
Yes, and medical bills, which we don't want. It's a tax deduction, but we don't want it. Thanks for listening. I'm Esther Gillius, the Tax Lady. Talk to you later. Bye-bye.
WBEN Buffalo, WKSE3 HD3 Niagara Falls.
Always live on the free Odyssey